What's up? So I'm in the new place. I'm absolutely exhausted, but you just gotta make time for the weekly videos. Anyways, today we're going to talk about the tax benefits to purchasing real estate and owning real estate. I think this is such an important thing that people forget about when considering to purchase real estate as an investment or even as their primary residence. So the first tax benefit to owning real estate is you are able to write off or deduct mortgage interest. Every year, the lending company or mortgage company that you ended up purchasing with will send you a statement showing exactly how much you paid in principal and how much you paid in interest over the course of that year. Interest you paid can be written off as a deduction. So if you have a mortgage payment of $1,000 per month and $500 of that is going towards interest, at year's end, you will pay approximately $6,000 in mortgage interest, which can then be deducted from taxes, which is huge. That said, kind of piggybacking off of that, reason number two, this includes interest deductions from things such as HELOCs, home equity loans, etc. The catch is with these HELOCs and home equity loans is the money that you take out or the money that you get a loan on has to be used towards home improvement. If you want to deduct interest on something like this, a home equity loan or a HELOC, do not pull this money out from your home and go purchase a boat or a car. Number three, property taxes. As a single owner of property, you can deduct up to $5,000 in property taxes. If you're married, you can deduct up to $10,000. Anything over $10,000 is not deductible. There are only a handful of places in Iowa where property taxes are over $10,000 per year, but for those single homeowners out there, it's not hard to find a property with a $5,000 property tax stamp on it. Number four, mortgage insurance premiums, or in short, PMI. This one's for my house hackers out there, my first time home buyers, anybody that's paying less than 20% down when purchasing property. You purchase a property under 20%, you get what's called PMI. Private mortgage insurance. It's a small insurance policy that the bank is putting on you for lending you a large amount of money and for you in return giving such a small amount to them. But once you hit 20% equity, that PMI drops off. And this varies per lender as well. Some are above 20%, some are below 20%. Some of it depends on your credit. There's a lot of variables that go into it, but 20% is pretty average. According to the IRS, PMI is essentially the same as mortgage interest to them. So when it comes to filing for taxes, it essentially can be written off in the same regard as mortgage interest. Number five, energy efficient upgrades. The government likes when people are green. This year in 2021, from January 1st to December 31st, if you installed solar panels or an electric water heater or electric appliances, if you had those installed in 2021, you can deduct 22% of the total cost of that upgrade. A simple incentive from Uncle Sam for us to be more energy efficient. Number six, rental expenses. I love this one. If you rent out a room, if you rent out two rooms, if you rent out the whole place, you can deduct the expenses from this. You will pay taxes on the income that you're receiving, but there are a lot of write-offs if you're using it for a rental purpose. Insurance, repairs, general maintenance, utilities, property taxes. The list goes on, and you can actually do what's called depreciating your property as well, but I'm going to save that for a later video. Now, the last tax benefit that you can get from owning property is kind of an interesting one. Well, it's not the last tax benefit that there is. There's so many of them out there, but this one's kind of interesting. You can write off what's called home office expenses. For my self-employed peeps out there, you can actually write off your home office or the space that you use in your home for office use. Even if it's just a little desk, yeah, you can write off 8 square feet of your home and consider it an office space. So here's the cool part. Let's say you have a 500 square foot garage and you converted it into an office, or you use it as your primary workspace. If you made that garage your office, if you're a carpenter, you made that your workshop, 500 square foot garage can be used as a tax write-off. There's two ways you can calculate how much of your home office can be deducted. The actual expense method, and there's a simplified method. The actual expense method is multiplying the actual costs it takes to own and operate your home times the percentage of how much your home office takes compared to your whole house. Keep it simple. If you have a 1,500 square foot house and your garage takes up 500 square foot of that, and it costs you $15,000 per year to own and operate your house, your home office or your garage takes up 33% of your whole house. So you take that times 15,000. Your home office or your garage, 500 square feet divided by 1,500 square feet, takes up 33% of your house. So you take that times $15,000, the cost that it takes to own and operate your home. You can deduct up to $5,000 per year on your garage or your home office. Now, the simplified method is simple. We're just going to deduct $5 per square foot of business use in your house. That's it. But if you use the simplified method, you're only able to deduct up to 300 square feet. For the same example, 500 square foot garage is being used as your office. Using the simplified method, you'd only be able to deduct 300 square feet of that 500 square foot garage at $5 a square foot. Using simple math, you're only able to deduct up to $1,500 of that office space. So the difference here is it's a lot more work to calculate the actual cost of owning and operating your home, especially over the course of a year. And sometimes they actually ask for proof of some of these items if you are including them into whatever it costs to own and operate your house. So it can be a little sticky, but if you're good at tracking all of those expenses that it takes to own and operate your house, you can see the difference in the deduction amount here is like $3,500. Might take a little bit more work, but if you do it right, it could save you a lot more money. That about wraps it up. So thank you for watching, and I'll see you guys next week.